The Federal Reserve just dropped a bombshell that's got the whole town buzzing. It's like we've hopped back to 2007. Yep, interest rate cuts are making a comeback. But what's the big deal, and why should you care? Let's jump in and untangle this financial event. The Fed swoops in whenever the financial waters turn turbulent, caped like a fiscal crusader, cutting lending costs to jolt the economy awake. In times when the market feels more like a chilly autumn morning, the Fed turns up the thermostat by reducing loan rates, stimulating spending across the consumer and corporate landscapes. Conversely, when the market is ablaze with activity, the Fed steps in with a cooling breeze of higher lending costs, a strategic move to prevent the economy from running too hot. Now, how does this whole matter affect you? These rate roller coasters can touch everything from your home loan to your credit card bills and even that shiny new car you've been daydreaming about. A drop in lending costs can be your green light for big-ticket buys, while a hike is more like a yellow light, time to hit the brakes on spending. Let's break it down. Bond market moves. When the Fed cuts lending rates, bond yields often take a dip, making them difficult for investors. But when rates increase, loans get pricier, which affects everything from your daily expenses to your long-term financial commitments. Credit card chronicles. Lower lending costs can take some pressure off your credit card debt, making repayments more manageable. But when rates climb, that debt gets more expensive. However, it's not all doom and gloom. Your savings account could start looking pretty juicy. Mortgage madness. Dreaming of a new home? Lower rates can bring those mortgage payments down, nudging you closer to your dream home. But when rates rise, those payments go up too, which might make you pause on that house hunt. Car loans get cheaper with lower rates, but higher rates could pump the brakes on your auto aspirations. Inflation alert. Watch out, if stuff gets too pricey, the Fed might hike rates to keep inflation on a tight leash. Stock market shenanigans. This is where the scenario gets a tad quirky. Lower rates often invigorate the realm of equities and shares, giving a lift to investment portfolios. Still, increasing rates tend to have a dampening effect. However, the response in this financial arena can be intricate and multifaceted. Why the 2007 flashback? We've seen this episode before. Rate cuts aren't just about making money cheaper, they're about jump-starting an economy that looks weary. They can be a big help, but they're not a cure-all. So, what's the bottom line? These rate tweaks are the Fed's way of steering the economic ship through calm and stormy seas. We've got to be savvy about how these changes impact our wallets. If you dug this deep dive into the whirlpool of interest rates, smash that like button and hit subscribe. Drop your comments. Are you tweaking your financial playbook because of these rate shifts? Stay tuned for our next video, packed with more juicy finance wisdom.